Hey, my name is Ankit Agarwal. I'm the founder of Option Up, and we have some exciting things to show you today. So, we'll go through what is option selling and how you can collect rent on stocks you already own. And then we'll go over how you can use Option Up to really level up your investments. So, before we get started, just a quick disclaimer, this is not investment advice. We are just purely trying to educate and teach you on how option selling works. This is going to be purely informational, and any examples you see here do not have us like endorsing a particular stock or a particular investment play, but it's purely to teach you the mechanics of how does option selling work and how you can use that strategy to generate cash flow. And then please do your own research. As with any investment strategy, there is always a certain level of risk associated with it. And please only invest money that you're comfortable with losing, especially in the beginning, since you'll just be learning the basic mechanics on how everything works. So before we jump in, just a quick overview of what will be covered today. We're going to go over why you should adopt the option selling strategy to generate cash flow. There's always risk associated with any investment strategy, but option selling tries to mitigate that risk as much as possible, and it could be a great way to consistently generate some cash flow. And then we'll go over what is an options contract. So very basic review on some terminology and just some very basic, basic mechanisms about options contracts themselves. And then next we'll go over into the mechanics for option selling, and then we'll in that process we'll talk about the two different option selling paths you can take, whether it's with a covered call or a cash secured put. And then lastly, we'll go over Option Up and how you can use our platform to really level up your investments and make the best decisions possible. So let's jump right in. So why is selling options a great strategy? So with any investment strategy, the way I kind of like looking at it is like, even if you're investing in real estate, one part of your strategy is to generate some sort of cash flow that you can just use as like recurring revenue. And then there's also a part of your strategy that is more geared towards growth. So growing your capital that you have. Now, option selling is more geared towards the cash flow side, where you can consistently generate some sort of income that you can use to like offset your expenses or just have like a passive income that's coming in on a monthly or weekly or whatever cadence that you want. So option selling is great for generating cash flows, and it's relatively safe because the way I kind of like thinking about it is you are selling the option, so you're kind of playing the house. So you're not trading on like the time value for the options themselves, but you get to actually own the underlying asset. So you're not really bound by time in the same way as if you're buying options. And because you're selling the option, the time value, the theta decay, which we'll talk about in a little bit, what kind of works in your favor. So as time passes, usually that works in your favor because the time value of the contract would depreciate. And the profit of your option selling play comprises of two different pieces. One is a premium you're going to be collecting, and then also there can also be a part of the appreciation of the stock, which you can take advantage of. So with these three things, selling options is a great strategy. I've been doing that for many years now, and a few people around me have also started doing it, and a lot of people have really positive things to say. So moving on to the next topic on what is an options contract. So some very basic review that can help glue things together later on in the presentation. So an options contract is an agreement. So when you have a stock, you're owning a piece of equity in the company, but with an options contract, you have an agreement between a buyer and a seller. So if you have a call option, that agreement is basically saying that the buyer of the contract is agreeing to buy that security, whatever the contract is on. They're willing to buy that security at whatever given strike price. And then if it's exercised, the seller must sell that security at that strike price, no matter what the current value of that security is. So for example, if I am doing this on a house, and when I buy the call option and the house is $100,000 and the strike price is 110, so then a week from now or a month from now, if that house goes to $200,000, I get to still buy it at $110,000 because that was a strike price. That was the agreement that we both came to when the contract was written. Now, with a put option, it basically works the complete opposite, where the buyer of the contract agrees to sell the security at the strike price. I won't get into too much detail with put contracts. I think they can be a little counterintuitive, but even if you just understand the call options, it can be a great kind of foundation to help you understand how options work. So for both types of contracts, there's always an expiration date from when that contract expires, and for how much time that the buyer of the contract has to assign the basically assign the agreements of that contract. So moving on, let's talk a little bit about what the selling options basic mechanism is. So when you're selling the option, you sell the contract. So you write the contract and you basically agree to buy or sell that security at a given strike price. And then you would put up your shares if it's a covered call, or you would put up cash if it's a cash secured put as collateral. So with covered calls, you are putting up your 100 shares as collateral. And if the buyer of that contract decides to exercise their right, you have to sell your shares. So if I have 100 shares of Apple, I would have to sell my shares at 100 shares. I would have to sell my 100 shares of Apple at the strike price that we agreed upon in the contract. Now with a cash secured put, if the buyer exercises their right, you must buy the securities at the strike price. So the cash you put up for a cash secured put serves as a collateral to buy the shares at the strike price that you determined. So with a covered call, you have to sell your shares if you're assigned. With cash secured put, you have to buy the shares. So it works kind of the opposite for when you are on the buyer side. So we'll look at some examples. I know this can get really confusing, but we'll look at some examples coming up on how this all really works. Before we get into that, let's just review some of the terminology here. So a security is a financial asset. So that can be a stock, it can be a bond, it can be options. It's a financial asset that can be traded. Now, a broker is going to be your platform which you exercise these transactions. So it can be something like E-Trade, Robinhood, Charles Schwab, TD Ameritrade. Those are basically standard brokers. The strike price is the price at which both parties agree on. So for any given asset, if the strike price, let's say the asset's $100,000 and then the strike price is $110,000, then basically 110 is the price that we're agreeing on, whether one party has to buy the shares at that price or sell the shares. And then the premium is the price paid to buy the options contract. So that's the value of the contract itself. It's not the value of the shares or the underlying security, but it's the price of the contract. Now with options, everything is done in batches of 100 shares. So if you see a contract that's priced at $1, that's $1 per share. But with 100 shares, you would have to multiply that by $1 by 100. So basically, the final value of that contract will become $100. And then there are kind of two very common terminologies for contracts. So you have something called in the money. And for when you say in the money, that means there's some sort of intrinsic value. So that's when, for a call option, the price of the asset or the security is higher than the strike price. So that's what in the money is. Now, out of the money is the complete opposite of that. So for a call option, that would be where the current price of the asset or the security is below the strike price. So when that is below, that means the entire premium value of that contract is just time value. There's no intrinsic value, because if I were to exercise that contract today, it would be worthless. I would be losing money. And then another thing we'll talk about is called rollover, where if I'm selling a call option and I don't want to sell those shares, I can roll over my contract and just basically push the expiry by one week or by however much time I want, and I get to hold on to my shares for a little bit longer. And we'll talk about how that mechanism really works. So moving on, let's look at some examples for what is a covered call. So covered calls you can do when you own at least 100 shares of a given stock. So if I'm selling covered calls on, let's say, Apple, I have to own at least 100 shares of Apple stock to be able to do that. Now, if the option expires out of the money, as we were mentioning before, So you get your collateral release. So if I'm opening up a covered call, if I'm selling a call option, I have to put up 100 shares as collateral. And if the option expires out of the money, meaning the current value of the stock is less than the strike price of that covered call option, then the options contract expires completely worthless. I get to my shares that I put up as collateral get released, and I keep the premium completely. Now, if the option expires in the money, meaning the current value of the stock is higher than the strike price, then you are forced to sell your shares at the strike price. Now, you can also have the option of rolling over your position before there's an assignment. So before the buyer exercises their right, you can essentially buy that contract back and then sell a new one for a further date out. And you can usually collect still a little bit of premium for doing that, because contracts that are further out are usually worth more because there's a time value associated with it. So I can keep pushing out my contract further and further if I don't want to sell it. And there's also a chance of early assignment. So this usually happens when the contract is deep in the money, meaning the difference in price between the current asset value and then the strike price is very large. Usually that's when early assignments happen, and some people like exercising their contract a couple of days earlier. So if the contract is expiring on Friday, it's very possible that someone might exercise their right on like a Thursday morning or Thursday evening even. So now let's look at an example. Let's say you have a house which is currently valued at $100,000, and then you have the seller of the contract who sells a contract for a strike price of $100,000, expiry date of 1 month from now, and they're going to charge the buyer $1,000 for this contract. So what does that mean? This basically means that the seller is willing to sell this house for $100,000, no matter what the price of the house is going to be for the next month. So for the next month, if the house is $200,000 at any given point, the buyer still has the option to buy that house for $100,000. And that contract, or that ability for the buyer to buy the house for $100,000, the seller is going to charge a $1,000 premium for that ability. So now let's look at 3 different scenarios for when this trade is profitable, when it's break even, and when maybe you're at a loss. And we're going to look at this from the seller's perspective, because that's what we're talking about today. So the first example, we're going to look at the out of money example, where the price of the house is actually lower than the strike price, where the price of the house actually went down by $1,000 at expiry. So because the house is now worth less than the strike price, this contract essentially expires worthless, because nobody in their right mind would want to buy this house for $100,000 when they can just buy it for $99,000 in the open market. So from the seller perspective, I still get to keep that $1,000 that the buyer paid me for the contract. That is permanently going to be mine, no matter what. And because the contract expired worthless, the house kind of gets released back to me. It's not collateral anymore for the contract. So now when I have the house, even though my net profit here is 0 because the price of the house went down by $1,000 and I collected $1,000 in premium, so both of those values offset, I still get to keep the house. So what I can do is month after month, I can keep selling these premiums for $1,000 and keep stacking those gains. And then eventually when the house kind of goes back up to maybe $100,000, $105,000, whatever price, I can get to realize the appreciation for that. So this is a key kind of difference between option selling and options trading. In option selling, you get to own the underlying asset. Let's look at another example. Now in this scenario, let's look at an example where you are in the money, where the price of the house is higher than the strike price, and you get assigned. So what happens here is, because the price of the house is $102,000, the buyer is going to exercise their option. So they're going to still buy the house for $100,000, and because the house is worth $102,000, they essentially will make $2,000 on their investment. But from our side, we get to keep the $1,000 in premium, so that's going to be our net profit. Even though I'm selling the house at the same price as what it was the original cost basis for me, I am still getting to make that $1,000 from the premium I gained from selling the option. So I still went out here. Now let's look at an example for a rollover. This is slightly more complex, but once you do it once or twice, it's super easy. So let's say I wanted to keep the house and I wasn't willing to part ways with it. So what I could do is, because the house is worth $102,000, which is $2,000 above the strike price, the value of the option is also going to be roughly around $2,000. So what I can do is now I can buy that contract back for $2,000, and then I can sell a new one for a month out. And when I do that, I will be able to collect another $1,000 in premium. And then now my adjusted cost basis is $98,000. So now my total profit so far is going to be $2,000. And I can keep doing this week after week. If I don't want to sell the house, I can keep rolling it over, keep collecting premium until I am ready to part ways with the house. Now, there are some risks associated with that strategy, but we can talk about that at a later time. I don't want to confuse you. At a basic, this is how it works. So now let's look at the flip side of this. We just explored covered calls where I am selling a call option. Now let's see what it looks like when I'm selling a put option. Put options are just the complete opposite of a call option. Again, because we're dealing with options, these are in incremental batches of 100 shares. And then same thing, if you expire out of the money, you get released your collateral. Now, the main difference between cash secured put and covered calls is covered calls, your collateral are the 100 shares you already own. With cash secured puts, your collateral is the cash to buy the 100 shares that you don't currently own. So if you get assigned in a cash secured put, you have to buy the shares. Again, similar to covered calls, you can do a rollover on your position where you can buy the existing contract back and then sell a new one out into the future. And in this case, if you get assigned on your contract, whether it's assigned on the day of expiry or even early assignment, you have to buy the shares. Let's look at an example. We'll keep things simple, so we'll use the same house example. Your house is still, this is not your house actually currently. The house you are selling a put option for is currently worth $100,000. I'm going to be selling an option again for $100,000 is a strike price, meaning I am willing to buy this house for $100,000, and I will have to put up the collateral in cash to be able to do that. And then this expiry is going to be 1 month from now, and I'm going to charge the buyer a $1,000 premium to be able to buy this house. Now, this is a little counterintuitive, but the way this works is the opposite of a call option. Basically, I'm saying I'm willing to buy this house for $100,000 no matter what. So tomorrow, if the value of this house goes from $100,000 to maybe $60,000, I still have to buy the house at $100,000 because that's what I promised in the contract. So that's how selling put options works. Let's look at a couple examples here. Now, the first example, again, we'll look at an out of the money where now in this case, the house value appreciates. So the house went from $100,000 to $102,000. Now, obviously, the house is worth $102,000, so the buyer would not want me to buy the house at $100,000. So the contract expires out of the money. It's worthless. It goes to zero. I get my cash released, and I profit that $1,000 for the contract because that's what I sold it at. Since you don't own the asset, there's no really real adjusted cost basis here, so we're going to ignore that for now. The next example we'll look at is if you get assigned. So in this scenario, if the house now dips by $1,000, I have to still buy the house at $100,000. So I am essentially assuming a unrealized loss of $1,000. Now, because I sold an option and I got $1,000 in premium for selling the option, I get to basically offset the loss from the value of the house depreciating with the premium gain. So my adjusted cost basis is still $99,000. So my net profit is basically nil. It's zero. Now let's look at a similar example where I'm rolling over the contract. So if it's at $99,000, I'm like, hey, I don't know, I don't want to buy this house right now. I want to keep selling in an option, I can basically buy that contract back for $1,000 because it's in the money by $1,000. And then I can sell a new contract that's maybe another month out for $2,000. So I still profit $1,000 from this trade because I collected $1,000 the first month, and now in the second month I'm collecting another $1,000. So even though the house is worth $1,000 less, I've collected $2,000 in premium. So my net profit here will be $1,000. So hopefully that's a quick introduction on how option selling works. We have a bunch more videos on Option Up, which I'll show you shortly, which you can continuously get refreshers and go into more details. And we have other opportunities to continue to learn and get educated on this. So we started Option Up to build easy to use tools. I first personally built this website for my own use because it's really important to track your option selling trades in a particular way. And most people use Excel spreadsheets to do this, but Excel spreadsheets are not robust enough and they just take a lot of time to manually review, make changes, and they're just not an efficient way to be able to track your progress. And brokers kind of give you an overall account view, but they don't give you a distilled view of your option selling trades. So it's really hard to know if your overall position is in profit or not. And that makes it really tough to know what strike prices and what expiry dates to really pick. Now, with Option Up, you can really look at the data and kind of see trends. You can see insights, and that will really help you maximize your gains. We have a bunch of features which I'll walk you through on why this has been a real game changing for me. We also have a really strong community of folks that you can reach out to. You can ask questions, and we can answer them in real time. And I also have weekly office hours that I'm doing for a limited time to help people answer questions or just help educate people on how option selling works. So let's take a quick tour of options. So let me move myself here. So when you land on the landing page, we have a few different kind of options you can take here. No pun intended. You can, if you want to learn more, you can go to the learn page and check out all these videos that we have to learn more about option selling or option basics, or if you're even more advanced, you can learn about the debit spread strategy. But we have these videos that talk in more detail about what I just showed you. And then we also have an FAQ page, which will just answer basic questions in general for you. So let's go back. And then you can also start a 30-day free trial here that gives you full access to all of the features we have, where you can track your stock positions. So a few different metrics I really like here are just seeing your target return price. I personally target a 2% return per month because that's a very safe way and it prevents me from getting greedy. As long as I'm making a 2% a month return, I am happy. Now, you have to have a very different mindset with selling options than just buying or selling shares or buying and selling options or buying options themselves, because this is a cash flow generation opportunity. You cannot get stuck in the opportunity cost. So if my stock I buy and it just jumps up really fast and goes really high and you're like, oh man, why did I sell an option here? That will always lead you to lose money in the long term, because you have to really understand that your goal is to generate the cash flow. Whatever monthly return target you have, you can shoot for that. But as long as you make that target, you should be happy with your investments. Anything more than that is a bonus, and you cannot be chasing after premiums directly, and you cannot be chasing after appreciation. Remember, we have two distinct portfolios. One portfolio is for cash flow generation, and the other portfolio is for appreciation of your assets. So you need to think about those two things completely differently. So I personally like keeping my target or my strike price above the target return price, so I never kind of get caught when a stock dips and jumps back up. So in Option Up, you can click on any one of these shares, and then you can see all the different covered calls you have sold against those shares. If I have a new position I'm selling, let's say for Apple, maybe I sell a position for $2.20 strike price. I get $1.50 out of it, and the expiration date is, let's say, 2 weeks from now. So one contract. Let's say I open it up on Friday. So I can just enter my position here and see my position status. So I can see if it's in the money or not. I can see overall my current stock position and how that investment is faring. And I can compare that with the rest of my investments. You can do the same thing with your cash secured put plays. And then this view is also really cool. It gives you an overall kind of previous positions overview. So you can see between all of your stocks, which one is performing the best, which ones did you get the most premium out of, which ones did you, excuse me, which ones did you not get too much appreciation out of. So you can really optimize your strategy that way. And then you can see historical, your different stock positions you have. You can see different cash secured put positions you have. Let's look at one that has kind of both here. So you can kind of get an aggregate view of how different plays have done. Now, if you would like a more visualized view, we have this portfolio summary view that gives you a month by month breakdown of how you have done, how much cash flow have you generated, and you can aggregate this by different metrics, and you can play around with this to really optimize and hone in on your strategy. This is extremely, extremely helpful for me because when you look at macroeconomic trends, different types of stocks will pay at different times. So when you look at this view, it really kind of helps you get an idea and plan for the next month ahead. The next thing I absolutely love here is the tax estimator. Again, this is a very, very, very rough estimator. It does not account for a lot of the intricacies in our tax code, but this does give you a very high level idea on how much you're owing. And this helps me understand how much I need to prepay and how to make sure I am compliant from a tax code standpoint. This is extremely, extremely helpful for me and makes sure that I don't fall under penalties, because the penalties are extremely severe, because not only do you have to pay the taxes that you owe, you also have an interest payment that's tacked on usually. You can click on this link to go to the office hours Calendly page. So this is a page where you can schedule some time for office hours, and we can set up a quick call and just walk through any questions that you have, right? So these are very open-ended sessions that I'm willing to talk about anything. One thing I will not tell you guys is what specific stocks to pick, because everybody has a different risk thresholds. Everybody has different cash amount that they are willing to play with. But I can help you identify and know what to look out for before you pick up your own stock. So going back to the page, we also have a bunch of tutorial videos that help you navigate through the website and see how to open up new positions and basically what do all these different features do that we just talked about. And then lastly, you can manage your account here. You can manage your payments, and you can also subscribe to OptionUp on our pricing page right here. So for pricing, we start off at $35 for our 2 individual kind of functionality that we offer. And then if you want everything, you can get a bundled deal for $49 here, which is a great deal. Each one of these things individually would be $70. So try to make it as valuable as possible for all of our subscribers. And we have a bunch of really awesome and great features also in flight that we're super excited to share with you guys. So with that, thank you for your time. Really, really appreciate it. And if you have any questions, you can reach out to us through our Telegram channel, or you can email us at hi@optionupapp.com. Again, that is hi@optionupapp.com. So please email us if you have any questions. I would be more than happy to get in touch with you. Thank you. Bye-bye.